That's also important. We just noted recently in our newsletter and an update, because we also have daily and weekly updates when necessary, that we've had this treasury bond channel we've tracked for a long time, and we're getting back towards the low end, right about maybe 2.4%. We hit 2.5% last week. This pretty much is also saying we probably assume the worst for the economy for now. Stocks probably have bottomed, and we're going to probably start anticipating a downturn. We haven't quite hit the bottom of this channel, so I suspect stocks may correct one more time. Bond yields may go down one more time. We'll show later probably a pattern where we don't make a new low, but we may come somewhat close to testing the new lows. But we're getting close to a strong buy opportunity in stock and even stronger in commodities and oil and gold and silver. And for people who are in bonds, you should not be in long-term bonds right now. Rates are likely to go up. In fact, they could go up dramatically if we really have an inflationary blowout with this stimulus. So the best thing to do is now get into TIPS, get into inflation-protected bonds, or go from long-term bonds into short-term maturities. So very important. A lot of people have been moving from stocks and commodities in the crash into bonds to be safe, especially treasury bonds and T-bills. Well, T-bills are fine, but treasury bonds are not a fine place to be here, especially if we go a little lower. So real quickly to kind of sum up, here's our scenario one, that we do start seeing signs. Our weekly leading index starts turning up. We start seeing signs of maybe a recovery, increasing hope. And the stock market bounces to something like 11,000, 12,000. We could get up to 13,000 too, but we've kind of ruled that out now with the extreme of this downturn. We're looking for a B-wave bounce, bear market rally after the first wave down, the A wave. And then we'll have a continued C wave after that from mid to late 2009 into at least late 2010 and probably ultimately into mid to late 2012. So again, if we see stocks bounce into the spring or summer this year, kind of a choppy bounce, people should not be selling now on this panic recently. They should wait for this bounce, and we'll be given the best signals we can, probably somewhere between 11 and 12,000, saying, okay, take your money and run. Again, this is not a normal cycle where you buy on dips. Things are going much lower, so you need to get out if you haven't already gotten out. And we gave signals months ago when we broke through the kind of 9,700 and 10,000 support area saying, look, things are going substantially lower. There's no support until we get down in the low 7,000s. And then, of course, we get, like in the Great Depression, there'll be a bounce in between. We've also got some demographic bounce into about 2017 or 18. So we get a bounce for years, and then we go down again like we did in the late 30s. Now, note, when we have these bubble bursts like this, or these depression scenarios, even though the demographics are down long-term, because of the bubbles bursting and the increase, the incredible strain on the banking system and bankruptcies and stuff, we tend to hit the lows in the stock market early on. We hit the lows in 1932 for stocks, and we hit the lows in commodities in 32 and the lows in housing and unemployment, highs in unemployment and the lows in housing in 1933. Those were lows for a long time. Here's scenario two where, no, we get more of a meltdown. People keep hoping for a recovery, but things keep getting worse. Stocks in this case may just bounce back to like 9,400, 9,800, and then we're back down or something. So we think this is less likely, but we're monitoring for this as well. And again, this is a tricky market, so important time to keep monitoring. And recently here we've been telling our newsletter subscribers that it looks like what we may have here is what we call an inverse or reverse head and shoulders pattern on this bottom, where we put in the left shoulder in October, the head of the low, and in mid to late November, and then we're rising up towards this kind of declining neckline, and then we may go down one more time, not a new low, but anywhere from maybe 7,800, 7,700, maybe 8,000. And then we shoot up towards our targets around maybe 11,000, 12,000, our B wave. So we're looking to see how this works out. And then, we gave some evidence earlier that the bond channel is giving us some hints there as well that we may play something out like this near term. So again, long-term crisis, we probably don't see getting out of this coming out of this till around mid to late 2012, early 2013. I'm telling people that's the first time you want to start looking at real estate. You have to be patient here. The whole point of view for investors is to move into cash as different areas and bubbles peak. And again, we're saying, hey, hold on to stocks now, but But hey, maybe as early as April or this summer, sell those stocks that we get back to decent levels, turn that into cash, and even more so, buy commodities here. Oil at $40 could go to 80, could go to 100, could go to 150 or higher. Huge gains. That's probably the last bubble to peak. That could be as late as early 2010, late 2009. And then you turn that into cash and liquidity. And then when we finally see bond yields peak in the next crisis because of credit scares, even on treasuries, then you lock in long-term yields. And we go into this a lot in the book. That's a little too detailed and invested, but there's a whole sequence. This is not a simple process where you just sell stocks at the top and buy bonds. Even the bonds, you have to wait into the crash before yield spike. And this happened in the 1930s. It also happened in the 1980s, commodity deflation. So we look at that in depth in our newsletter and our book. And so there's going to be a whole series of things to do. And so the key is to keep your cool here and toot our own horn, listen to people like us that seem to understand this, because this is nothing like anything anybody's seen in their lifetime. It's not even 100% like the Great Depression because of this commodity cycle and this heroic effort of the government to inflate our way out of this.